And I guess a good one to answer off this one is Jeff's question here about fixed indexed annuities. They sometimes get a bad reputation because of their fees/commissions. I like their ability to replace bonds in a portfolio. Are there specific FIAs you prefer over others? So right off the bat,
Okay,
unfortunately, that
Mr.
last part of the
Compliance.
question, for compliance reasons, we cannot answer.
I've got my chief compliance officer right here with me today. So
Yeah.
no, we're not able to talk about specific financial products. So we can't even.
But generally, I mean, we
into this.
can say a little bit about fixed index annuities and, using them in place of bonds and things like that, though, because that can be a useful approach.
Absolutely. I've done a lot of studies along these lines. So real quick, the basic idea of a fixed index annuity is you link it to some stock index like the S&P 500. It will be linked to the price returns because it's going to use, this is getting technical, but financial derivatives that don't give you a total return. They are only linked to price returns. So that means capital gains, not the dividends from the stock market index. And then you have principal protection. If the stock index is negative, you don't lose any money. If the stock index is positive, you will share in the upside, but you won't get all the stock market upside. Usually they'll have a cap. If the cap is, say, 8%, then that means if the S&P 500 is up, between 0 and 8%, you'll get whatever that is in terms of the price return. If it's up more than 8%, you're capped at 8%. But now every year you're going to get interest credited to you at somewhere between 0 and 8%. And to the extent that the stock market is up more often than not, you're going to average somewhere closer to the 8% side than the 0% side. What if that number is exactly, you'd have to it would depend on what you're going to assume about stock market returns. But then you compare that to bonds. And if you have taxable bonds, you're going to be paying taxes on the interest every year. If you have bonds in an IRA, you get the same tax deferral benefit as the annuity provides. But then you look at it on an after-tax basis. Even though the index annuity is linked to a stock market index, it's not an alternative to the stock market. It sometimes gets pitched as getting stock market gains without the risk of the stock market. That's not what it is. It's potentially a bond alternative for the portfolio. And that's where, in the work that I've done, I think you absolutely can look at these as part of the asset allocation mix as a potential part of your fixed income allocation in your portfolio.
And real quick, just because there was a theme here with Bob's question and now with your question here is just in terms of annuities and recommending annuities and things like that, there needs to be a broker in the purest sense of the word broker involved, because these are contracts. These are significant contracts that you're essentially signing. There's no like market, like the New York Stock Exchange, and you're buying an ETF and you put in a ticker symbol for the S&P 500, SPX, buy 1,000 shares at this price and you're done. That doesn't exist. Hence, that's why even Wade said earlier, there needs, right now, the way it is there has to be here's a good one, Bob, interlocutor.
There you go.
There needs to be kind of that middle person, because they're contracts. And so it's not just a matter of, hey, what are the good, and they change all the time. They change all the time, whereas right now the S&P 500, the SPX ticker, it's going to be the same 5 years from now, 10 years from now, etc. And so, but that's not the same with the types of contracts that are issued, that are annuities. And so you just have to keep that in mind. There's no clearinghouse, if you will, for these contracts. Just wanted to say that. That's why you can't just get online and buy one.
Yep. So,
I have to ask this one because this goes back to the distribution one. John Reckenthaler just wrote an article on Morningstar indicating that higher bond yields now support a 4% withdrawal rate. Assumption is 30-year withdrawal period and a 50-50 portfolio.
Yeah, I think that's consistent with the answer I gave earlier. To be clear, all I was saying was just because a 30-year TIPS ladder supports 4%, you can't treat that as a guarantee that a diversified portfolio would support 4%. But that being said, now, I mean, all all John did is Monte Carlo simulations, where now that interest rates are higher, you can assume higher bond returns, and then potentially with a risk premium added to that, higher stock returns. And yeah, that's going to make it much more likely that the 4% rule would work in today's interest rate environment. So I mean, in terms of the math behind what that calculation is telling you, I don't disagree with it.
Look, but this is what at the larger level though. I kind of want to disabuse William for thinking like this is even important, because I bet you when I read that out loud, Bob and Wade's answer internally was like, yeah, so who cares? I mean, and we're folks that, okay, you can say I don't know what I'm talking about, that's fine, guilty, right? But you got Bob and Wade, and they're very learned about this subject matter, and it doesn't matter. I think we just need to move on, because next year Morningstar will write something and say, take the current rate, do a Monte Carlo, and say, hey, now it's 3.6%.
Yeah,
and you're going to think, wow, this is it.
The point that I really wanted to tee off on there, because you skipped over William's parenthetical, saying it now supports a 4% withdrawal rate as opposed to a 3.3% withdrawal rate. That's the same number, guys. We should be talking in like big round numbers on stuff like this. 3.3 versus 4%, ex post facto here is the same number. We just
is that Harry Potter? Is that a Harry Potter reference?
I guess it's Latin.
Well,
I don't know. But there's no precision in any of this stuff. We can calculate these numbers out to as many decimal places as you want, but it just doesn't matter. It's significant figures from like 6th grade science. You can only measure as finely as your instruments, and our instruments suck in this type of context. And this actually gets back, there was a question earlier about efficient frontiers. As a purely theoretical idea, great, yes, they exist. In terms of using them to build your portfolio, I hate them. They're horrible. There is no precision here. Trying to place your portfolio on the efficient frontier usually is just going to hurt you. You're going to be optimizing your portfolio in very specific ways, and using those optimizers, the only thing you optimize is your errors. You're going to force yourself into a weird portfolio.
Just to talk about what you mean by that, usually you have these things called portfolio optimizers, where they take they take your asset classes, and let's just say you have a stock, bond, or whatever, and it comes with an expected return and standard deviation, expected returns, and so a mean variance optimizer will sort of place them. What's the best allocation to get this on the efficient frontier? But what you'll find is you'll get some weird results. You'll get something that says, I'm making it up now, but you'll get something that says large cap stocks 20%, REITs 70%, and fixed income 10%. And that's the best fit on the efficient frontier. No one in their right mind is going to look at that and say, that's what I'm doing, and then change it the next year based on standard deviation changes of historical stuff and returns changes. It's just not done like that. So what you do is you start putting guardrails around the optimization algorithm. And your guardrails are saying effectively, I want REITs, but no more than 5% and no less than 3%. I want domestic stocks, but no more than 40% and no less than 30%, something like that. So what you're effectively doing is just eyeballing it anyways, and putting some sort of thing that kind of makes sense. And so, I guess this is like a debunking Q&A to some extent, but I really wouldn't get caught up in the efficient frontier mumbo jumbo. I mean, it's great for academia, kind of thinking conceptually about what you're trying to do. But when it comes to precisely creating an allocation, I don't know any stand-up firm that does anything remotely close to something like that.
Well, to clarify a little bit what the question's asking about. So what you're describing is the modern portfolio theory style, and where you choose some asset classes, you decide on returns, volatilities, correlations, you throw them into that optimizer, and you get an asset allocation. And it's very sensitive to the assumptions, and you can get some very odd-looking asset allocations from that. That's not exactly what this question was getting at. I think it's more the retirement income version of it, which is just the broader.
Sorry, GMH. I'm sorry, GMH. I had that in me. That's an Alex problem.
Yeah, it's usually going to stick to the broader asset. Like, it's not 5 different bond funds that you're picking weird allocations with. It's more the stocks and bonds, income annuities. And then, the efficient frontier for retirement income. That's really one way to tell the story about how risk pooling allows annuities to help support retirement spending needs more efficiently than bonds do. Then they are asking about like just changing the bonds to stable value funds. I don't know that that's going to necessarily overwhelm the risk pooling through annuities, but at least to the extent that you don't have risk of loss in the same manner as you would with bonds, it's could tweak the efficient frontier a little bit. And then I guess we're getting back to your point of, yes, what sort of tweak do you get? I don't think it could potentially tweak it in a weird way, but I don't think it will. It's probably stable value funds will not get to the frontier either.
Right. It's the same problem with efficient frontiers, whether it's retirement income, whether it's purely investment portfolio. A big part of this is we're looking at historical data, we're making guesses about what the future is going to look like. We're going to be wrong in our assumptions. So we could go in and design the perfect portfolio for the last 30 years, the perfect plan for the last 30 years. It's not going to be the perfect plan for the next 30 years. So what we need to do is sit with what makes you comfortable. What looks like it pencils out, what looks like it's a reasonable approach that you can deal with going forward, that you'll be able to deal with however the market evolves and sit with that plan. If you're not able to stay disciplined, if that plan doesn't work for you, it doesn't matter because you're not going to be there.
And you're right. I think I am, being a little hard on GMH. It's just I saw about efficient frontier, so I went off on a little soapbox tangent. But yeah, I mean, ultimately, could stable value funds be considered as an alternative? And you answered that.
Sure.
And William, fires back, and he's right. Annuities have a bad rap because outside of SPIA, you need to invest a lot of time to understand them. And even then, FIAs are very difficult to compare because insurers do not use common terms. I don't necessarily think they get a bad rap because they're difficult to understand. I think the pricing, it's part of it. It's not just that.
Because then there's no transparency.
Yeah, it's more transparent.
Obscures.
And sometimes
it's a way to hide fees.
Yeah, and I would like you to address something here, Wade. But I would venture to say stocks, if you really get down into it, stocks, bonds, certain instruments, it's just anything with numbers, can become complex. I'm not so sure it's the complexity. I think it's just they're the transparency issue. Plus, I do agree, insurance do not use common terms. Even when we did our podcast, Wade, remember? There was they're not English terms. And so part of this is because they're English, but they're not used in the English definition of the word.
And more so, every company uses a different term for the same thing, which makes it super confusing.
Yeah. But I think, so and that goes back to their contracts. They're not something that there's a clearinghouse for. So every company has their own contract, and so they have their own internal jargon. And so, it does make it difficult. Now, you said transparency. If it's something that I think is interesting, and maybe if you can do this, it would be helpful. The difference between an annuity spread expense versus an actual fee.
Mm-hmm. Sure. Right. So pretty much any fixed annuity, including fixed index annuities, they're spread products. And you can think of it just like a bank. When you put your money in a checking account, they might pay you an interest rate. These, I don't know, it may not be very high, but the idea is the bank's going to earn more by lending out your deposits than they're paying you in interest. So there's plenty of fees on banking, but you could have no fee banking, the way the bank, it's not a charity. It's going to earn money by lending out funds at a higher interest rate than it pays to its depositors. Same idea with a fixed index annuity. They're often marketed as not having any fees, but and yes, there's no explicit fees, but the idea is there's a spread that whatever the insurance company is able to generate internally, they're going to keep part of that for themselves, and they're only going to give you part of that. And so that's where they stay in business. That's where they're able to generate revenues to maintain their company and so forth.
Got it. And Karen, I got you. Feel free to reach out to us. I mean, the last thing I would like is, you're saying you're not feeling at ease with money, financial fitness, self-employed, busy, many skills, but you're now older and suddenly faced with managing parents' money, health, and death. Just, if you need sort of a starting point and someone to point you in the right direction, just reach out to us personally, and we'll make sure you at least get pointed in the right direction with that. So thank you for your message.
Yeah, we got
there's a lot of questions coming in.
Yeah. What I'm doing, just a FYI, we're getting these on the chat. I'm kind of marking them off with a thumbs up as we get them in, so we know that we're kind of addressing them. Here's one. I just because it's out there. My family have said the only way to truly protect against a crash in the U.S., like Japan, is a brokerage in another country and invest via their currency versus an international index fund. Any thoughts? Or really something worse, like the U.S. going through what Argentina has gone through? I'll give this to Bob. The other thing I would mention here, as opposed to currencies, Bob, I kind of know where you're going to go with this, but how you can buy bond funds pegged to currency, that kind of stuff, or international funds that are also pegged. But take it away.
I'm not sure I'm taking it the way you're thinking there, but
okay, never mind.
My first take is, one, a lot of these conversations, it's really people's fears that are coming out here. And a lot of it, and I've been on kind of an inflation kick for the past couple months. A lot of those conversations are really political conversations in disguise. And I think this is probably one of those types of conversations. They're, from a purely economic standpoint, if the U.S. turned into Argentina, there's nowhere to hide. That the U.S. would take the entire world economy.
Robert Kiyosaki was right all along.
So from that perspective, I'm not sure, getting a foreign denominated brokerage account saves you in any meaningful way.
I buried the lead. You're right.
And I think it would be riskier if you're actually talking about opening brokerage accounts in foreign countries, because your opportunity to then gain access to those funds could be curtailed.
Right. Now, that being said, I mean, if you are worried about, moderately catastrophic stuff happening in the U.S.,
catastrophic is catastrophic.
Well, moderately catastrophic.
How is that? We only lost 30 states, not 20.
I'm not talking in terms of that level of catastrophe. I'm talking about the S&P 500 sustaining negative returns like 2008 for a while.
All right.
You can, one, shift out of equities into, safer bonds. So, U.S. Treasury bonds, maybe some Euro bonds, some big foreign government bonds, things like that are highly unlikely to meaningfully default. And that would be one way. There was a fad a while ago, catastrophe bonds that only pay off in terms of a natural disaster or something like that. You don't hear too much about those anymore, probably thankfully. But, it's really going to come down to, you need to build your portfolio with a very, very low level of risk. If you're worried about the financial system falling apart, but still operating, you want a very low level of risk in your portfolio. if you're worried about the financial system just falling apart, full stop, which is what the U.S. looking like Argentina means, go buy, beans and guns. Because saying that you own a gold bar or, shares of some commodity fund, if it's not on your person, doesn't mean anything. If that's the level of worry that you have, don't invest in risky assets. Don't invest in non-tangible things that aren't on your physical person.
I think Bitcoin solves this. Bob.
Absolutely.
Stepping back a little from like complete catastrophe, earlier in my career, before really getting into retirement income, I was part of a study that looked at like pension funds in different countries and their investment approaches, and really came to appreciate the idea of international diversification.
Yep.
When a country experiences economic problems, there's a reasonable chance that their currency could depreciate. And so if you are exposed to currency risk, you have a nice natural hedge against some domestic market volatility. So I do like the idea of broader international diversification without necessarily removing the currency risk involved in that. And maybe that's one way to get at the same idea here.
100%.
But that's something you should be doing anyway.
Yeah, but I think to Bob's point,
just don't open a brokerage account in another country, because that wouldn't end well.
We're reading it from the standpoint of, I was reading it initially going where Wade was going with it. You're taking it like catastrophe. If U.S. falls, everything falls. That kind of thing. And you're saying, what are you going to do, right? But I think Wade's right. Like, if I'm answering this question not just as a sort of a normal catastrophe, to use your parlance,
mild catastrophe.
Yeah, just diversify. You should be diversifying anyways. Bob is like, you should be diversified anyways. Yeah. Regardless if there's going to be a pending catastrophe or not, because I think that's what you need to disabuse yourself on. There is going to be a catastrophe. There is going to be there's always this wall of worry, and it's largely driven because of your political proclivities. I think the way to look at it is just, you want exposure across the globe, and that will help diversify you away from anything happening, in your domestic land, if you will. I'll leave it at that. And you could do the same thing with bonds internationally. All right, we're gonna Wade. Why don't you pick out some questions, Wade? I think I've been kind of dealing myself.
Okay, I did see one that was about building a Social Security ladder. I'm trying to find where that one went.
That one. That's Alan.
Where did it? Oh, yeah,
Alan,
there it is.
Okay, I got it. While I like the concept of building a bond ladder for a Social Security bridge, doing so would require selling equity holdings, generating substantial gains. While I have not yet modeled this in detail, my gut feel is that a total return approach might be more effective in this situation. Thoughts? And in parentheses, don't let Bob answer. Go ahead, Wade.
Yeah, sure. So we need a scenario for this. Let's say you're 62 years old and you're retiring. You've decided to defer Social Security to 70. What that means is for these next 8 years, you're going to have a much higher distribution need from your investments. And then once Social Security starts in 8 years, you still have to probably take a distribution from your investments, but it's going to be much smaller because you're going to get a 77% inflation adjusted increase in your Social Security by waiting for that period. So how do you fill that gap? And the issue with the total returns portfolio is that increases sequence risk. If I have to use a higher withdrawal rate for the first 8 years and then a lower withdrawal rate afterwards, I'm exposed to a lot more sequence risk. A downturn can really derail that portfolio more dramatically. So the reason why the term Social Security delay bridge exists is to try to move away from that idea of just using the diversified portfolio total returns approach to cover that much larger distribution need before Social Security starts. Now, if it does require generating a lot of taxes to build the bridge, that's certainly a consideration, but maybe as part of a tax planning situation, if you're retired and this is all long-term capital gains, you've got a pretty big runway, at least before you actually start to get into that 15% preferential income bracket. So there could be some opportunities there, but more generally as well, if you're not at the stage yet where you need to build this bridge, you could start layering it out. Oftentimes, the way we describe building a bond ladder for retirement is if you have the runway for it, if I'm say I want to have a 10-year bond ladder at the time I retire and I'm 10 years away from retirement, each year, instead of investing in bond funds, I build a layer, buy a 10-year bond that will mature 10 years later. And then by the time I get to retirement, I now have a 10-year bond ladder in place without having to build it out all at once. And so to the extent that it's possible, you might think about something similar with how you approach building a Social Security delay bridge.
Yeah, and I think that actually answers Leeward's question there at the same time about, really kind of the same question. I'm an income need matcher, more time segmented than not, and open to pull from equities versus fixed income in good market years, and also use guardrails until Social Security at 70. I mean, that's really kind of that same sort of thought process. Obviously, not exactly the same, but that same sort of thought process into how to build that level of reliable income to bridge that gap into Social Security.
Okay.
Yeah, and it's building a lot of the different pieces that we talk about as all being part of viable strategies. Of course, we can't really comment directly on your personal situation there, but at least the building blocks are there for something that sounds reasonable.
We kind of missed this from Lee just as we're knocking these out. And it seems, guys, we're going to have to probably at some point stop. We'll give it a few minutes here, but maybe this is good for like a reoccurring theme because it seems to be nice participation.
Yeah, we have a lot of questions still, so we could make this a more regular thing with the blog and the podcast. I mean,
this question I get, but I don't. It says, for safety first, folks, my outlay needs in the future. Think about a $30,000 roof in 10 years. Have me drawing at that time. However, I have this element of hate. I have this element of I hate the thought of the big draw. How do I reconcile?
So if I think this question may
imagination,
be
I have no idea.
If every 10 years you need to take out $30,000, you want to somehow amortize that and take out $3,000 every year, and behaviorally maybe it sounds better. But I don't know how. It's just you can plan ahead for that, and if you're more safety first, it's back to this idea of the total return portfolio. You don't necessarily want to take that big distribution out from a total return portfolio where you have to take it that year, and if you get a bad market downturn right before that, you're taking a pretty big distribution at an inopportune time. Maybe you do layer in a fixed income holding that will mature. And if although I guess with the roof, it's kind of estimating 10 years versus knowing exactly in 10 years that you'll need to replace it. But layering in some sort of bond holding to do that so that you're not as exposed to a big distribution all in 1 year.
Yeah. And I think this really comes down to, you need to make sure you have a big enough pool of reserves. Those reserve assets that are not earmarked to specific spending and usually not in, substantially risky assets. They might be in, short-term bonds or something, but they're not in the stock market type of thing.
Yeah, and this is where the research can be helpful to help determine true versus technical liquidity and identifying a strategy that may be more tailor-made for Lee. But I do agree. I mean, if you're having trouble cutting a check for $30,000 and that could sort of dent your distribution, especially if in year 8 the market goes to hell in a handbasket and you have to take a distribution, then just do it over time and put it in some interest-bearing account that matures at that set time. Right?
Yeah, that could be used for like a quasi buffer asset where you do have some reserve asset that if markets are doing fine in 10 years, you'll take the distribution from your portfolio, but you've got a backup where if you need to take that distribution, you have some other resource.
We need like a Dave Ramsey chat GPT, because I'm sure we'd get a we'd get a good answer here.
What is it? All right.
All right. So we got here. You want me to continue here? There's do you agree that the benefits of using an FIA versus a bond portfolio is that the FIAs have no interest rate risk, credit risk, market risk, and risk of depletion in terms of outliving your income? So the FIA is a panacea for everything bad in the world. versus having a bond portfolio? What's your take?
The way that statement is expressed does sound a bit like a marketing angle on the FIA. So I wouldn't. I mean, there is interest rate risk to the extent that you have each term you renew the terms of the contract, and so if interest rates decrease, the cap may have to come down. There is credit risk because you are relying on the insurance company to support what it says it will support. Like there's less market risk to the extent that you have principal protection. But yeah, I mean,
It sounds like a
and then
marketing pitch.
with the risk of asset depletion, I'm not sure what to make of that exactly. Are we now adding a living benefit to the FIA, or I do think that research that I've done speaks positively about the potential role for annuities, especially with lifetime income protections, as part of a retirement income strategy. But yeah, it's not a complete panacea, I should say, for every kind of risk out there.
No, you're right. Panacea.
Panacea, right? I don't know. I said it wrong.
Trying to bait me here.
I'm messing you. But yeah, it does seem markety the way that question was asked. Williams giving you props, Wade, for it's a lack of transparency about annuities. Yeah, I agree. I mean, and yeah, it is unfortunate because I think many people just walk because they don't even bother. It's just one of these mental shortcuts that you take. Annuities bad, markets are good, and they move on. And that's actually quite unfortunate because, as we've seen with Arisa, look, 2/3 of the people want some role of contractual income for retirement income. That's just what we see repeatedly. Not a value statement, just an observation there. You want me to read the next one? I am an income need matcher. More time segmented
that was the one
than that.
From Leeward we kind of touched on in that broad.
Oh, that's right. When you combined them. Yeah. Sorry. Let me see here. Thoughts on using? Okay, we thought about this earlier. It came up in a write-in question too. Thoughts on using bond funds with different durations to use instead of bond ladders. Pros and cons, and how does distribution yield and reinvestment risk play into this? Thank you, Greg. That's a good question.
Yeah. In an accumulation world, there's something called duration matching that it doesn't matter if you have the bond fund with the right duration, you're not going to be exposed to interest rate risk. Now, at the same time, that does exist with retirement income, but it is extremely.
Duration. Wait, I'm sorry. Just if people aren't going to know.
Yeah. So, well, the non-technical version of it, the basic, without getting into any weird aspects of it, it's the approximate time to maturity for the bond. And the longer term maturity for bonds, they're more exposed to interest rate risk. If interest rates go up, a longer term bond is going to have a bigger drop in value than a shorter term bond. So if you have a bond with the same duration, or a bond fund with the same duration as your expense you're trying to fund, you can avoid interest rate risk. And with that argument, you can say it doesn't matter whether you use a bond fund or an individual bond. In retirement income, that's still true. It's just the duration of your liability in retirement gets a lot more complicated. And so it's much more difficult to use bond funds without creating interest rate risk for yourself. It's not impossible. And there are a few commercial enterprises that have developed solutions, but they're uncommon because it is so complicated. And that's why I think it's much easier to think about bond funds instead of somehow duration matching your bond funds when we talk about generating income in those short-term buckets.
Yeah. No, I mean the way to think about it is generally the bond funds are going to be in part of your risky asset as just part of your investments. You use them to moderate, the level of risk in your portfolio. Individual bonds are more on the reliable income side. The one complication, we always get this one, is those defined maturity bond funds, where it will be a fund that will own only bonds maturing in 2027, to pick a year. And those
because they want to do the work for you. They want to do the work for
exactly.
you. They just figure, We'll just buy them ourselves in the open market, as
Yeah,
opposed to you needing to do that, and you buy it in the ticker symbol, and you're home.
right. And
That's it.
those can be useful tools if you're building a bond ladder or matching specific spending or something like that. But it's you're paying for convenience. Those have an expense ratio. Um, and there's nothing wrong with paying for convenience. We do it all the time, every day. But it's just important to recognize, you are paying for that. Yep.
Great.
That's an excellent
So
answer, Bob.
maybe we'll wrap it up with one more question from Karen. It is a complicated question, but it's so with my book, and probably the best kind of starting book to think about would be the Retirement Planning Guidebook. But is it appropriate for beginners in terms of using it for a book club, because the members of that club have so many retirement or financial questions? So I do get a little hesitant to suggest the book for pure beginners, because it's a complicated book. It's definitely for people who have some basic stuff. Yeah, it's not that it's not like math or anything. It's just there's a lot of complexity, and sometimes the reviews on Amazon do tend to suggest that the book is too complicated. So I'd be a little hesitant to suggest it for pure beginners. However, if there is somebody who can guide the book club and who is able to answer questions or make sense of what everyone's reading, it could be possible. It's just, I don't know of a better option to suggest, but at the same time, I wouldn't want you to have everyone get the book for the book club and then everyone just tells you that they can't understand anything the book's talking about. So that would be my only caveat.
The way I would think about it here is the book is not a book to read from the first page to the last page in a sitting. It's a resource handbook, guidebook, better said, hence the title. To me, it's what you put on the shelf and you go back to when you're like, oh, let me I have Social Security in my head. Let me see what the state of play is. Or I'm thinking about long-term care. Let me see what the state of play is. That kind of thing. That's really what it gets at. So I don't, to read that from cover to cover takes tenacity, takes ambition, and takes Visine. It's one of the things that, no, it is what it is, right? You'd get more out of it, I think, if you read the first, as a book club, read the first chapter, take the Risa,
or the last chapter too,
or the last chapter. You're right, or the last chapter. But take the Risa and discuss that experience. And then you have the book. And if it's something that you do decide to do as a book club, let us know. We'd love to help you out. We think it's kind of fun.
Yeah.
All right. And with that being said, I think we probably should wrap things up for the day. But we've gotten so many great questions, and I don't think we did answer most of the ones that came in live. Maybe not all of them. Something might have snuck through the cracks there. We still had some questions too that came in beforehand. So we should do this on a more regular basis. I think it's a great opportunity to interact with everyone. And thank you for listening for 100 episodes, or if we end up putting this into 2, now it's episode 101 as well. So thanks everyone for being part of Retire with Style. Thank you, Bob, for joining us today. Thanks to Bree and Amber for all the work you do behind the scenes. And thank you to you as well, Alex, for being a great co-host.
No, the thanks goes to you. You just make it easy. You make my job so easy. I just say, Wade, and off you go.
All right.
All right, everyone. Thank you so much. To 100 more, right, Wade?
That's
that
right.
Doesn't sound right. I said like white Wade, like right Wade. I can't even say it. Alliteration.
Absolutely.
Correct, Wade?
You are correct, sir.
Thank you. And Robert, any parting words?
No, I'm really glad I was wrong, and we kept at it, and I like you said, to 100 more.
Yeah. YouTube channel.
That's right.
All right, everyone. Thank you so much.